Hello everyone, this is Mark here, and my channel is Finance and Fitness. Today you'll notice a different background. Thought my cat would be a good prop, and my abnormally large plant, so I hope you enjoy it. Today I want to take you on a journey, a financial journey, with the stock market. I think a lot of people, the question that comes to mind is, when should I buy my stocks? How often? And I want to cover that today with a great example that I found on Reddit. I'll provide the link below. Also, if you want to sign up for Robinhood, there's a link and you can get free stock for signing up. With that said, today I'm going to go over 3 different scenarios with 3 different people. 2 are somewhat unrealistic, but what people tried to do, and 1 is a method that I do. What we're going to be talking about today is investing, so buying and holding, but in 3 different ways. Now, some people think it's good to buy and sell and trade stocks all the time, try to, sell when it's high and buy when it's low, but I guarantee and promise you're never going to be able to time the market. That's never a good idea. So I think it's always good to buy and hold. So these 3 examples are going to be between 3 individuals. One named Tiffany, one named Brittany, and one named Sarah. The scenario is that each of these individuals saved and invested $96,000 each. They both bought in to the S&P 500 index, which covers the whole S&P 500. So Tiffany, you have Tiffany, who has the worst timing in the world. Then you have Brittany, who has the best timing in the world. And then you're going to have Sarah, who just buys every month, whether the market's up or down. She buys and holds every month. But we're going to start with Tiffany. And this example is just to kind of show you that A, you can't time the market, and B, sometimes it's best to not, go off of emotions when you invest. So let's start with Tiffany. Tiffany has the worst timing when it comes to investing in the stock market. She saves $200 per month, which will be in every example, and she decides to put her money into a savings account that gets 3% interest, which is unheard of today, but this is the example. She invests at the worst possible times in the stock market. Now, what would that be, the worst possible time? Well, that would be when the market is at its highest, right before it drops. So you put your money in, and then you see your investments decline. She started saving for 8 years, had that money in a savings account, and at the absolute market peak in 1987, right before the Black Monday that resulted in a 33% crash, she put her money in at the very peak. But she never sold, and instead started saving her cash again. So she just saw that loss, but she decided, okay, I'm not going to sell my investment, I'm going to keep investing. She, at the next market peak, invested again. She did this a few times where she invested at the very peak, and then she saw the market go down drastically, but she did not sell her investments. She held on to them. And she did this right before the 2000 financial crisis and other crises that affected the stock market. So with this perfectly bad timing of always investing at the peak, Tiffany still did great with her investments. Her $96,000 that she saved and invested over 40 years, at the end of that 40 years, was worth $663,594. This was even though she invested at the worst possible times. But the key is that she held those investments. She did not freak out and sell them like a lot of people do. So that's the power of buying and holding. Since she never sold and she kept her investments, she was able to far surpass her original $96,000 and turn it into that $663,000 ending result. So that's Tiffany, the terrible timer. Now we're going to talk about Brittany, who is amazing at timing the market. She is a genius. She can basically look into the future and know exactly the market bottoms. So she can buy in at the bottoms right before they start to go up and make a profit for her. So Brittany, she also saved her money in a savings account until she was ready to buy at those miraculous times that she was able to predict the market. She bought at the very bottom when the 4 biggest crashes over the 40 years that she invested occurred. So in 1990, with a war breaking out in the Middle East, Brittany dumped all her cash in when the market fell 19%. And then again in 2007, it fell 56%, so a lot more, but she knew those bottoms each time and she was able to put her money into it. Again, she had perfect timing, invested at the very bottom, but she held her cash. She never sold it for a profit and tried to do other things with her money. So for her perfect predictions, Brittany was rewarded. Her $96,000 over the 40 years turned into $956,838. So that's really good, and that's a 44% gain over Tiffany, who had terrible timing. Again, buying and holding is what she did in a low-cost index fund, S&P 500 fund for those 40 years, just like Tiffany, but they both, one had the worst timing, one had the best timing. Now let's bring in Sara, or AKA myself in a way. So Sara, she's the slow and steady one. She invests every month no matter what. She never put her money in a savings account to sit on the side until she was ready. Every month she just like clockwork put her money in, whether the market was doing great, whether it was doing bad, no matter what the news was, no matter what kind of scary things were out there that might create people to pull out or buy at the peaks. She just did her $200 every month into an S&P 500 index fund. And she never looked at her account. She did a set it and forget it. So she did automatic investments, $200 a month for 40 years. And remember, she did not put it into a savings account. She just put it right in when she would get that $200 every month. So when Sara was ready to retire, she looked at her account. And to her surprise, her investment of $96,000 grew to $1,386,429. Even though she could not time the market perfectly, she still beat Brittany, who was a genius at timing the bottoms. So it goes to show you that if you buy and hold, that's the key, because the market is always over time going to go up. And if you only hit the perfect timings, you're going to miss out on the growth in between, and having your money in there earning the average, stock market gain of 7%, whatever you want to say, it's like between 6 and 8, rather than having your money sit in a 3% savings account. Plus, especially that compounding of dividends, if you add that into this equation, I'm sure that makes a huge difference. So there you have it. You have, the $96,000 that they invested over 40 years that they put into an S&P 500 index fund. And you have Tiffany, who is the worst at timing the market, bought at all the peaks, and made out with $663,000. You had Brittany, who timed it the most perfectly way you could. She was like, she looked into the future. She came out with $956,000. But then you had Sara, who just invested no matter what and came out with $1.386 million. The key here is you can never perfectly time the market. It's impossible. I can't tell you how many feeds I'm on and people are predicting a crash or a big gain, and it does not happen. I don't care who you are or how smart you are. You can never time the market. It's its own animal, and there's no way to read that and know what's going to happen. No matter how smart you are, how much news you read, the market is unpredictable. So it's never a good idea to try to time the market, because most likely you're going to end up like Tiffany, who does it at the most terrible times. Worse yet, if you try to sell at the peak and buy at the lows, that's not going to happen. That's like winning the lottery. It's just not going to happen. The best thing to do is put your money in every month, no matter what the stock market's doing, no matter what's happening in the world. As Warren Buffett said, when people are fearful, that's when you should be greedy. Greedy with buying stocks, greedy with investing in the stock market. Because while people are, freaking out, pulling out their money, and you're putting your money in, then when that recovery happens, you're going to be able to ride that up. Where people that pulled out when they freaked out at the bottom, they weren't thinking. They were going off emotions, and then the market goes back up, and then so they sold low and they're buying high, and they lost a lot of profit that they could have made in between. So this example I've liked. I've seen a few other YouTubers cover it, but I think it's an important one to cover, because people get a little too brave thinking that they know what they're doing and they can time the market when that's not the case. You just need to be a steady Sara, or myself who just invests every month. Make sure you diversify, choose stocks you believe in, choose some index or ETFs because those are going to reduce your risk and increase your diversification. And just kind of set it and forget it as much as you can. But make sure you invest every single month or as often as you can, every 2 weeks, every week, whatever you set up. But I think it's best to do it, at least monthly, if not more like, bi-weekly or weekly, and just put your money in there and it will do great for you compared to people who try to time the market. So I hope this video was very helpful. I hope this kind of makes sense. Look into it yourself. Look at a graph of the S&P 500 over the last 40 years, and you know what you're going to see? It's going to be a clear climb up. You need to, just think about this. Try to put your emotions and pride aside and realize that you can't time the market. Nobody can. It's best just to choose your good companies, your good index funds, invest in them regularly, and you're going to come out with a lot of money in the end. Based on the history of the stock market, it always goes up. It's never gone down over a 20-year period, so it's good, especially if you're younger. Just start. Open up an account. Open up with Robinhood. Get it going, and just make it a habit. Make sure you're investing every month at least, or more often. So with that said, have a great day. Get started investing. Really think about this. Think about being a steady Sarah and what that can do for you versus trying to be a genius and that we know that we can't be with the stock market. Have a great day. We'll see you next time on Mark's Finance and Fitness.